Thanks for joining us. Today we're going to talk a bit about the evolving requirements of MGAs and their insurer partners. We're slightly biased on the panel because we have an MGA and 3 insurers and 1 wannabe insurer. So we'll try and go through that. But we're quite fortunate to have Darren Doherty, who's Chief Executive Officer of Pioneer Underwriting Limited. And Darren's been at this task for 5 years, 6 if he tells you about the burdens that Lloyd's put on him to get going with people, which I resemble that remark. And then also you'll see John McClellan, who's UK Head of Portfolio Solutions for AIG. Next to him is the Chief Underwriting Officer of Watford Re, Alistair Spear-Coles, who's been in the London market for quite a few years and has a pretty keen understanding of what makes things work. And then next to him is James Weatherstone, who's President and CEO of Arch Insurance Company Europe Limited, and a provider of capacity, and I think has some interesting things to say to us because of some of Arch's activities to do alternative capital solutions, but we'll let him go into that. But I thought it'd be first, the best thing to do is let Darren talk a little bit about what he sees as an MGA who deals with folks such as ourselves all the time and some of the changes that he sees in the market. Following that, we'll ask him a few questions or make a few comments, and then I'd like to encourage all of you to ask us questions, because then if you don't ask any, I'll have to ask some, and it'll be far better if you do. So, Darren?
Yes, so I was asked to comment on the capital that sits behind MGAs and how that's changed over the last 5 years. I think a couple of things have influenced that. One is there's been a significant increase in MGA activity across the whole market, but also new markets and alternative capital are looking at MGAs as quite a neat way for instant distribution and access to market sectors. So certainly in the last 5 years we've seen, in my opinion, a shift from traditional insurance capacity, which normally is the traditional binding authority delegated play. You've got a movement from reinsurers into insurance, so there's a significant move across the market where reinsurance has become more challenged and reinsurance capital has decided to deploy that into the insurance space. So we've seen a number of reinsurers targeting MGAs to support that business. We've now and increasingly got alternative capital coming and looking at MGAs. So we've got renewed interest and increasing interest from hedge funds, pension funds, private equity, private capital, high net worth capital, all of which is looking to enter into the market. They're looking at the returns that have been enjoyed over an extended period, and with limited areas to deploy their own capital, are looking at the insurance space as an interesting return, and are targeting MGAs in terms of putting their capital behind it. Now, the challenge they have, obviously, as raw capital is that they haven't the licenses or the rating in certain classes of business, but they are, via a couple of reinsurance brokers, finding ways of transforming that capital into deployable insurance capacity. And certainly the biggest influx we've seen and interest we've seen is in that area. I think a lesson for us to learn is to look at the US, because a lot of what happens over in the US tends to filter through over here over a period of time. The US MGA space is significantly more advanced and bigger than it is here. And there's a lot of interesting plays going on out there in terms of alternative capital backing MGAs via fronted arrangements, via interesting mechanics. So I think over the last 5 years we've seen a significant change. I think people are recognising the MGA space as a good source of distribution. MGAs tend to have a niche and are looking to outperform the market, so it's normally a good place for the capital to deploy capital into a different market sector. And so I think overall we've seen a massive shift in terms of people that are backing MGAs. Significant interest from the traditional carriers, significant interest from reinsurers trying to get into insurance, and increasingly alternative capital.
Yeah, I think just to add to that, Darren, I think there's increased competition, absolutely no doubt, between, as Darren says, alternative capital and your more traditional capital. I think probably a question for the rooms, certainly from an MGA standpoint, is, I guess, the difference between passive and more active investments. So certainly the more traditional capital investors can offer different things, I guess, tools to support your own value proposition. So thinking about claims expertise, people, product, a whole bunch of things that can be offered through a more active investment play. So I think as the dynamic shifts, as you outlined, I think that's something that the MGA definitely continues to wrestle with, and it creates opportunity. I actually think competition is really healthy, but it's got to be channeled in the right way, and it's got to, for me, it's got to deliver value both ways, both from a capital provider's standpoint, but also for the MGA as well. And that's my point around active and passive investment.
Yes, and I think that it's very simple or easy to look at the MGA space as a single type of activity, but there is a huge range of MGAs, from those which are largely distributors of risk to those who are truly virtual underwriters. And the way that plays with different types of capacity is important. The reinsurer generally who is going into this space does not have the skills to set rates or set terms or conditions, and he is looking to a team of people, a virtual insurer, to do that, where there are others who bring quite a lot of that ability and are therefore looking for more for distribution.
Yeah, I'd echo Alistair's comments. I mean, we see a great diversity within the MGA space, and it's becoming more marked, I think, as the competitive environment evolves. So, at the one end, you've got some mega MGAs who are effectively global players. They have a fully formed infrastructure. Apart from being uncapitalized, they look and feel like an insurer. Right down to what Americans would call the mom and pop shop, who may have a specialty and a niche, and they're deeply expert in that niche, and they love it, and we make good margin there. And I think carriers and alternative, funds have to determine, which way they want to go. But certainly the diversity that we're seeing starting to build and gain momentum on the carrier side is definitely mirrored on the MGA side.
So, not to be wholly without controversy here, with the MGA having to adhere to certain things through the carriers that support them here in the UK for the FCA's requirements on treating customers fairly and any other number of things, oftentimes some of the carriers can offer some support in that regard. The question is, have you had any experiences with alternative capital to see how they would handle that burden? Or does that push that back on the MGA?
I think, if I jump in, at the moment alternative carriers are infrastructure light. They do not have the requisite on-the-ground resource to give you that sort of guidance and assistance. So I think if you're looking for that, and if you're looking for the carrier to effectively shoulder some of the burden, and I think the FCA is looking to the carriers to shoulder that burden because we have got the resource, then I think the traditional market is probably the better place for you to search. Having said that, I think alternative capacity, alternative capital, call it what you will, is getting more sophisticated, and there are ways and means to bridge the gaps, particularly on the regulatory end, which is becoming increasingly a focus for MGAs in the way they're constructing their plan.
Okay. Darren, have you had any experiences with alternative capital in this regard?
We've put the alternative capital into entities that effectively bridge that gap so far. That's the way we've transformed it, so it's been carried out by somebody in between.
Okay.
I think if you were going to look for where this industry might occasionally come off the rails, it's where there is a mismatch between the abilities of the carrier to support, not just in terms of compliance, but also in terms of underwriting and the MGA itself. So I think getting that complementary set of skills is really important. and not every carrier is going to be right for every MGA, and vice versa.
With that, are there any questions from the audience relative to this issue, the alternative capital, how it fits?
You talked a little bit about why alternative capital doesn't necessarily fit around compliance. Why does it fit? Would be, I guess.
Why does it fit when it fits?
Like, what's the biggest kind of positive that it brings to the table in comparison to a traditional carrier?
Well, I think that the term alternative is widely used and misunderstood. My view of alternative means cheap. It's lower cost capital. It's capital that expects a lower return on capital. It's capital that hasn't had the mid-teen returns on capital that the industry has enjoyed for a period, and therefore it's looking at lower return requirements. And when compared to current interest rates and other opportunities where the funds can be deployed, our industry looks quite interesting.
I disagree with that. Only
I am the minnow amongst minnows.
So if you look at Arch Insurance is the traditional carrier, and we were determined that we would probably have the worst named insurance company or reinsurance company in the business, so we created Watford Re. And just for the avoidance of doubt, Watford Re is the bridge that spans between the naval centre in Bermuda and the mainland. So it's nothing to do with, our nostalgic sort of view of Watford. So in terms of setting up Watford Re was capitalised at about $1 billion. It got an A- rating. It doesn't have licences. What it does have is access to Arch's underwriting and distribution. So every deal that we put into Watford is underwritten by Arch Insurers, and we take 15% quota share on every deal that Watford can take. So it's not like we're going to suddenly create two rules, one for Arch, one for Watford. The reality of what's going on is that with low interest rates, which have prevailed for the last decade, the returns on long-tail business have been decimated. What Watford offer is a more aggressive asset play for their high net worth, and we use Highbridge, which is a JP Morgan company, and it's their high net worth unit that manages that asset. So whereas Arch, our shareholders and our customers wouldn't vote with their money if Arch took that sort of asset side risk, Watford can. And because they can, we can offer better solutions to customers when we are hand-tied with this low interest rate environment. So I think what I would say is it may appear cheaper, and there are different entities out there who would be alternative. As far as Arch's entity is concerned, we take a share we eat our own cooking, so we're not going to screw that up. And also, I think the attraction to customers is that we can offer potentially higher commission, because we can take a lower underwriting loss ratio, ultimate loss ratio, and we can still make a return that keeps our investor base happy.
I think sorry, Alistair, just to add to that, I think it is about, I think you mentioned alignment of interest. So whether it's, and I think it's a really good question, alternative capital or more traditional capital, I think the challenge for the room is to really understand what is the value. So what is the value proposition? What is the offer, traditional versus alternative? And then I guess you place your bets, you take your chances. So if you touched on compliance as being one area where certainly from a more traditional capital provider's perspective, there's a lot of investment going on in that area, particularly as we're seeding more delegation of authority to third parties. It's really, really important that the due diligence, the governance and the compliance all work. So you see more investments going into those areas, which could and should help MGA operations more generally. And you can apply that to claims and other areas as well. So I think it's a really, really good question. And I think it's about you guys assessing the value proposition of the alternative sources.
I was going to say that in a world where you can argue that modelling is not a static, it's not even on a linear increase, it's been on an exponential increase in the ability to model severity and frequency of risk. There is a temptation, shall we say, to segment businesses that people feel that they can really understand the frequency and severity, and go to carriers who believe in that frequency and severity distribution, and therefore can allocate a relatively low amount of economic capital to a particular situation, which means that the return on that, which might be also smaller, means that you could be much more competitive from the provision of a capital point of view than someone who probably hasn't segmented that in the same degree. That is, if you actually are confident about the modelling. I think the issue with that is there is a lot more to our business than just calculating the theoretical frequency and severity around a niche of business. Price setting is only one part of the equation. How you handle claims is also extremely important. And so as people break away from the traditional carriers, maybe to set up MGAs, and they produce business plans with figures around that frequency and severity, it's some of the soft stuff which is going to be really the issue both for carrier and MGA. And it goes back to what Tom said. It's about compliance, it's about claims handling, it's about treating customers fairly. And for the carrier, it's what happens when the venture doesn't work out and they're still carrying the baby and the reputational risk.
So what I think I'm hearing is that it's sort of horses for courses. The different MGAs have different skills and attributes. Some are big with big infrastructures and easily able to handle the FCA queries directly if you needed them to, rather than fading the heat through the insurance carrier who offers it. But one thing you shouldn't assume is that what's called alternative capital will go away. Right now there's about 69 billion of cat bonds. And to put that in perspective, that's out of a worldwide sort of reinsurance premium for cat of about 435 million, depends on which broker's estimate you use. So you have, that's sort of 70 billion out of 435. But if you look at the sources behind the 70 billion of capital, that's hedge funds, pension funds, some life insurers, and in fact some insurers and reinsurers as well. But if you look at the assets under management of all those people, and you said, I'm a cautious pension fund manager, hedge fund manager, I'm only going to take 1% of my assets under management and put them at risk in this, then you could have a supply of capital that's 10 times the size of the 69 billion and still only be 1% of the capital that you could devote from that. So I think we would all be wrong to assume that they go away. And since they want to make money and there is a depressed yield environment, they will, and they're pretty smart, they will find ways to do things. If you look at what Nafila is doing in terms of working with operations as MGAs in the States and some of the other sophisticated alternative capital providers or translator vehicles, they are coming. So I always say to myself, anything that can be commoditized will. And I need to learn how to trade in that environment of commoditized trades, or I need to get out of the way, because I would hate to have my economic efforts aimed at doing something that a commodity-linked guy used to say. One of the folks in Bermuda called me up and said, well, Tom, our costs are cheaper in Bermuda. And I said, you got to be kidding me. He says, what do you mean? I said, do you really mean to tell me that the laws of physics are different in Bermuda than they are here in the UK? Because I think the probability of an earthquake or a hurricane or some other act of God, which nobody really knows what it is, can't be really different between the two. No. But what is different is historically, if you looked at the evolution of the catastrophe market, people charge, in addition to the pure probability, a capacity charge because they only want to lose so much money in any one cat event. And if you're sitting on that amount of capital I just described, those guys aren't too worried about a capacity charge. They'll go closer to pure probability. So the real distinction where Darren is correct is they're willing to charge closer to pure probability than the rest of the traditional insurance market is, because they want to have a certain premium for putting a certain amount of their capacity at risk on those uncertain events.
And if it goes wrong, it's a rounding error on their overall result because they've got so much funds in non-correlating assets.
It's a good point Tom makes. I mean, I think the the origins, and you look at the Nephilas of the world, there's been a 10-year party on Nat Cat, and that party's over. And what it's taught these guys is that it was great margin. There hasn't been any caps of consequence over that period that they've paid out, so they feel emboldened. And then they thought, oh, we can go in and nudge the liability markets, longer tail, etc., etc. Now, we all know in our world that you don't necessarily know if you're charging the right price for another 5, 7, 10 years. But these guys do feel bold, so they are starting to muscle in on the liability segment. And I think that's the evolution. So you've seen quite I would say it's alternative capital 2.0 is probably looking more at a diversified book. It wants to appear more like a traditional reinsurer rather than what was, just a Nat Cat player. You're in, you're out, you win, you lose. So I think that's a subtle sort of shift that we're seeing evolve. What they're lacking is distribution. That's why they're locking on to either brokers or carriers or direct to market to try and find distribution. So you've seen a number of models announced but fail because they could never get enough critical mass to outrun their expenses.
Any other questions at this point? Okay, this might be a great time for you, James, to talk a little bit more about our Watford Re.
Watford Re, okay. I don't know a great deal about Watford Re, apart from they're a clever bunch, mainly because it's Arch Re underwriting, and I do know the Arch Re guys. I think the business is an interesting one in that Watford are going to become our competitor. It was always stated when Watford started up that it would IPO after a certain period of time, 3 years, 5 years. They're patient. We haven't got VCs sort of banging the drum as to when we have to IPO. However, that was the stated intent. So that will happen. What you're seeing very recently is Watford tooling up on the direct side. So it's got E&S licenses in the US. We have E&S licenses in the US. So they're becoming a competitor. They've got a Gibraltar insurance company, which was essentially set up to write a UK motor quota share. So, you can see them starting to eat our lunch, if you will. So I think it's only a question of when, not if, Watford make, direct moves in the UK. We're hearing sort of rumours about how they're accessing the market. They're still held, pretty much to the original startup rules, which are Arch Re underwrites every deal. But increasingly, you're seeing a divergence in terms of ambition. So I would say that we have created a competitor. We have to be cautious about where that competitor plays, but it does potentially give MGAs an interesting kind of problem to deal with. It's a good problem to deal with because it's competition. So Watford, I would say, if you're writing a longer tail, a longer duration account, you have a fully formed infrastructure that you want to leverage, then Watford may be a better bet for you because I'm sure they can offer better commission at this state of the cycle than we possibly could. Having said that, if you're not that and you want proper underwriters that you can call up and a proper claims handling function that you can call up, then you call Arch. It's kind of, it's that back to the horses for courses.
So, do you have any views on this?
Not from me, no.
No, I'm good.
Okay.
What would be interesting to see if there's how many imitators of this particular model there are going to be. But I think that, as Tom said, this sort of thing is here to stay. And as the MGA market becomes more sophisticated in Europe, it is sophisticated already in the US, it is sophisticated to some extent in the UK. The relationship between delegated authority and the London market is long-standing, but I think there'll be more and more delegated authority business arising in places like Italy and France, and Germany, as the mutuals themselves begin to come under pressure from Solvency II, I think some of the capital will come from exactly the Watford type model.
Well, the biggest, restriction is paper. So we need to find ways and means of plugging in licensed paper. Now, Arch can provide that, but we're pretty strict on the collateralisation, and that often takes the deal economics away for Watford. So sometimes they're better off finding independent fronted paper, and that is available.
Mm-hmm. Are there any questions about this? And the key distinction here is most of the alternative capital that's been provided has been for things like Florida and coastal wind exposures and things of that nature. Of a property cat, what Watford is somewhat distinct in, it's the first big effort to do it with casualty business, which has a longer tail, a longer feedback loop, and some other considerations that might make it difficult. For those of you who have casualty exposures, I'm pretty sure you may be using AIG or some of the other local markets here for it, but are there any questions you might have as it relates to that? And there's apparently a question that I did not see.
So why hasn't the capital just gone into the traditional insurer market through the bond market? Why have they decided to set up their own capital models?
I'll have a go at that. I think that if you look at putting money into an insurance company, whether that's through equities, bonds, preference shares or whatever, what are you getting? You're getting a little bit of the past, a little bit of the present, and a little bit of the future. The past, you're buying into a reserving situation. The present, the current trading position across all lines of business. And the future, because you're buying a bit of brand. And that's a very different proposition from the much more unitary relationship to risk, to a niche. And the extreme form of that, of course, is the ILS world, where you are literally buying into a single peril in a very controlled manner. But even if you are going into a relatively limited area of MGA business, you have a much more transparent relationship with risk. And you could argue that actually that's one of the changes in our lifetime between Lloyd's, where if you go back long enough, a name could put capacity behind an aviation syndicate or marine syndicate or a property syndicate or an LMX syndicate. That has gone with the whole of Lloyd's syndicates becoming a diversified play, driven by the need to support diversified portfolio and capital. And the counter to that is there are still people out there in the capital markets who actually quite like the idea of being able to directly invest in risk itself, or very much closer to the risk itself. So I think that's the answer why buying an equity or bond doesn't actually do the same thing.
I would agree with that. There's been it's not new news that there's a worldwide hunt for yield when interest rates are at this sort of historic low. These guys are clever. They're looking for, small margins, increments that they can win on. And I think, to echo James Gerry earlier, data quality, data transparency in analytics means that you can actually churn through a lot of data. The insurance industry was always great at putting a sort of hoodoo around it. We had a very successful moat for years and years that scared people away. But I think that's gone, and the gates are open now for quite a lot of people to take a good look at our business, and a lot of this data set is publicly available. You can pay to get research on it, so they are unpicking, these pockets and finding margin in there. So I think that's quite an appeal, and I don't think it's certainly not going to end. I would argue that it's hardly even started.
So, and to add a bit to what Alistair said, the investor would like to not make a decision which involves further investments. In other words, if you can get a pure underwriting play and get the returns on that, as opposed to giving your pot of money to somebody else who's managing a big pot of money, and get the investment risk on the other side. That's what you get with a traditional carrier. With these alternative vehicles, you've seen a pretty clear, maybe an asset strategy that you might otherwise be willing to invest your capital in, and you get the underwriting result. But it's an effort to try and get as pure or as close to the underwriting result as possible, because they feel like it's a diversified, uncorrelated risk. That's the good news. The bad news is it's diversified, uncorrelated risk. And you can't hedge out. An earthquake happens. And that's the big distinction. If you take a derivatives trader, they're pretty good. But what they get paid the most for is the risk that sits in their drawer overnight, that they can't hedge away, that they can't purchase options or futures to balance out. And what they call that is jump risk underwriting. So you have this jump risk and the market gaps. Like if there was a Tokyo earthquake and it shut down the market and the Nikkei didn't open up for another week or 10 days, there'd be that gap. And when I was talking to some derivatives guys, I said, well, the good news is when I was at Lloyd's, I have a whole building full of jump risk underwriters. That's all they do. They have to go to sleep at night knowing they've balanced their book or managed their exposure so they can wake up tomorrow morning post-event and still trade and still be in the business. And so the good news about insurance underwriting is it's created a whole group of people who are very good at managing the one risk that the derivatives guys have a hard time with. And so sometimes when you get those two groups together, you get some pretty interesting synergies. But it is a risk that people are trying to isolate the underwriting risk and get the returns for it.
That's fair.
And so, Alistair, there's an increase in delegated authorities. Lloyd's has increased its delegated authority underwriting as an example, but I think it's pretty reflective of what you've seen in the London market generally, of an increase in delegated authority underwriting vehicles and people trying to do that. Do you think that this increase in delegated authority business makes sense in the current market cycle and with some of the pressures we've talked about already? And I guess my follow-up question is, since you, in your role, have some involvement with both a reinsurer and an insurer, we see a lot of reinsurers trying to move up the food chain and get closer to insurance liabilities. Is that one of the big things driving this? Or?
Well, I think that's part of it. So let's start with that question, the second half of the question first. If you look at the last 15 years, and we've had risk-based capital has driven a lot of insurers to actually reassess the risks that they can keep. We've seen the move from reinsurance being a tactical purchase at a line underwriter level, and a lot of the derivation for reinsurance brokers of that business came from personal relationship. That's moved now to a corporate purchase with much higher retentions. The big companies, the AIGs, the AXAs, the Alliances, have hugely diminished, taken billions out of their traditional reinsurance spend as they've centralised both globally and by class. And so both the reinsurance carriers and the reinsurance brokers have seen a big diminution of what would be their traditional business. So in one sense, if you are a reinsurer, you have to do something slightly different. Then you go to the intermediary market, and again we go back to some of those relationships, which are 20, 30-year-old relationships where reinsurance brokers have dealt with particular underwriting teams. And whether it's push or whether it's pull, there is a temptation to have the conversation, wouldn't you be better off no longer working for your big company where you no longer have the ability to command your own bonus or buy your own reinsurances or whatever. If you were in an MGA, you would have more independence in terms of operation. There is capital out there will back you, and from the reinsurance broker's standpoint, and I can get a commission out of this again. So there are lots of drivers as to why people wish to go back to a world where they were masters of their own destiny to a greater degree. I said that thing about aviation syndicates. Well, you can't be an aviation syndicate, an aviation underwriter, and have a 20-year career writing aviation in your own little business. Now in Lloyd's, you have to be part of a bigger syndicate with everything that goes with that. So there is a people driver. there is a capital driver and there's an intermediary driver for recreating some of the London market in the form of MGAs and carriers that I think it is inevitable. Now, along the way, lots of people are going to make huge successes out of this, and along the way, there are going to be some quite spectacular failures, I suspect. But that's part of a marketplace.
Yeah. I think, Tom, you mentioned about does it make sense? It's a big question, increased delegate authorities. And I think part of the answer is actually the MGA space more generally is far more professional and has got a much deeper, certainly underwriting expertise, but far beyond that. So certainly from a traditional insurance company standpoint, and I guess similar from a reinsurer, that's attractive. So we're trying to understand where we can build an alignment with the right opportunity, with the right niche, for the right class, for the right reasons. I just think has become increasingly important as the market generally has improved its professionalism and its investments in this space. I think that's another factor.
Yeah, it's a good point. It's a good point. There's a couple of things from our own experience. I started with Arch in 2005. We were very much a London market startup built to write wholesale, i.e. second-hand insurance into London. We started the Lloyd's Syndicate in 2009. My experience of being a mid-sized carrier is that the weight of regulation, the weight of dealing with more sophisticated brokers who now want to not just sell you their information for a fee, but effectively give you binary options on their book, creates quite an overwhelming sort of set of issues for a middle-sized carrier. I never knew life could be quite so tricky for a $500 million business. So I look at the MGA model and almost breathe a sigh of relief that some of you have made the choices that you have for a slightly more entrepreneurial. I listen to this sort of entrepreneurial word all the time. I don't think it exists within the London wholesale market. I do think it exists within the MGA space because the creativity certainly seems to be migrating towards MGAs and less in the carrier area. And I think if you are avid readers of VJ Dowling, IBNR Weekly, he's been preaching for well over 18 months the idea that he who controls the customer wins. And right now in the wholesale market, that's the broker, and we're having to pay for that. Whereas I think with the MGAs, if you can get closer to your customer, if you can find solutions that the customer actually wants, not that the carriers are forcing down their throat, it's a better outcome for all.
Yeah, I've just got a point to add to Alistair's, and that is that the innovation that we're talking about, certainly the London-based MGAs, if you strip it all back, it's no different to what historically was, and apologies Tom,
go ahead,
an old flavour Lloyd's Syndicate. So if you think back 20 years or so ago, or maybe more, they were primarily third-party capital plays, underwriting risk for third parties. It was dressed as a managing agent and a syndicate, and if you think about a London-based MGA now, the role of that MGA is to manage the capital, which is primarily third-party capital, and underwrite the risk appropriately. So I don't think it's particularly innovative. I think it's just recreating history in a slightly different way.
Yeah.
The cynical among us would say there really hasn't been any innovation since Cuthbert Heath with the first burglary policy. And maybe that's okay, by the way. I think in this state of the market and all the competitive pressures you've heard us mention so far, and a few we will mention in the future, just executing well is pretty darn hard. And so if those people who can execute well, it seems to me, will be the winners, no matter how you want to call the innovative policy creation and responding to your customers. And I think that's something that will rule the day. So as you look at your businesses, one of the first things you said was about what you do in Pioneer, and find out what you're great at. You may not be great at handling FCA type compliance issues, so you better have business partners and capital partners who can provide some of that for you. But, you know, as a former boss, well, current boss of mine said, there's a lot of different ways to get to heaven. And so, but you need to figure out which one is best for you, and you're on the way there. So with that, I think, John, if you want to speak a little bit about the value proposition and what the MGA brings to the party, and then what the capital should do.
I think so. I think this follows from the last conversation to a certain point. But I think, first of all, just before I do that, Tom, I think it is about, and we touched on this earlier, about alignment of interest. And I think that's both, I guess, culturally and organisationally, operationally, between the MGA and the capital provider. I think that's point one. And the other point I'd make is around expectation from a timing horizon point of view. So in simple terms, if the capital provider is really working and looking to work with an MGA for a finite or very limited period of time, then clearly that's different if the MGA's approach is actually on a 5, 10, 15, 20 year potentially. So I think those 2 points really underpin what I'm going to touch on from a value proposition standpoint. So I think 4 big points for me: underwriting profitability and expertise that resides within the MGA. So I mean, we touched on this earlier, but I think you guys have been pretty adept at actually building, and in some cases specialist teams have joined different MGA operations, and effectively gives us access to business potentially that we haven't ordinarily got through our existing distribution. So I think that's point one. I think specialist underwriting, and obviously, you know, making a profit with the expertise that you guys now have is really important. The other big point, certainly from a more traditional capital provider, and we touched on this earlier, is really around cost efficiencies. So I think as your models get slicker, and I'm going to talk about technology later, and we transfer more activity via the MGA, underwriting, claims, administration, I think it's important that we recognise that through the financial models. The way that we assess profitability of the MGA, I think, is really, really important. Certainly we've taken big strides to clearly differentiate that, and that really does speak to 2 things: profitability and sustainability. It's different. The expenses are different from a traditional capital provider's standpoint. So I think that's really important. I think ease of doing business. So the MGA's capability, I give her to deliver ease of doing business, the operational infrastructure that exists, the support that's available, the technology that underpins a lot of the transactions, and also the data and the data quality, which I think the guy spoke with earlier, again, is really, really important from a value standpoint. So that's another key point. I think niche distribution, and you can align product strategy with that, but actually if you're actually gaining us access to business that we would not ordinarily see through very defined experts in your operations, and that clearly is attractive to us from a value proposition standpoint. And I guess last but not least, and I know there's a lot to this, Tom, but I think the governance, the compliance, the controls that you have in place, and this is my point earlier around the due diligence that we undertake and the importance of the alignment, is really important. So I think, you know, whilst at the front end, growing the business and having best-of-breed relationships is really, really good, I think the compliance and the regulatory aspects and the attention you guys pay to that is going to be increasingly critical now, but definitely in the future, particularly with potentially another change in regulatory environment that we're all operating in. So I think those 4 or 5 things are the big things from my standpoint.
Yeah, I'd agree with that. I'd just add another thing. Is in our experience, I think some MGAs have to have a more scalable proposition unless you've got a deep niche and it's protected. You know, there's quite a lot of frictional cost involved of you know, accepting these and running them from the carrier perspective. So there is a sort of frictional cost now that we have to embed when we're looking at these, and some people won't get over that. And what I'm talking about there is if you want us to take on, you know, the FCA, the kind of capability, claims handling capability, etc., if you get a bad one and a bad outcome, that can you know, completely overwhelm your infrastructure in terms of management time and expense for a considerable period of time, long after the binding authority has been cancelled and notice given, etc. So the run-off implications of getting a bad outcome is now quite is an expensive element of what we're looking at. So I think it's, you know, increasingly important to the point around compliance that MGAs don't have this sort of Wild West attitude to how they deal with, with customers and with carriers. Those days, I hope, have gone.
Okay. We did make it almost 45 minutes before the subject of Brexit was alluded to. So, just not to mention the 2.5 years till we absolutely know what anybody's going to do about it. But that does bring up something that's interesting, because as MGAs, you have a way to get close to where you think the market's going and how you need to tailor your services and how you're providing them, what countries you're going to provide them, and what infrastructure you need. And then secondarily, who your business partners are, whether they're alternative capital, conventional insurers, or an MGA working out of the London market. That question is all up in the air for the next period of time. And there's no real answer that I'm aware of, but it certainly is a pretty good question I think everybody should focus on a little bit. But you touched on another thing that maybe all of us should talk about a little bit more. The notion of expenses, and I'm not just trying to say no one person is wrong about this. The underwriters aren't wrong, the brokers aren't wrong, the MGAs aren't wrong, but over time society will not accommodate us charging 40 points expenses to deliver an ephemeral promise to pay that somebody might need. When you can do same-day delivery, Amazon's trying to have same-day delivery of something with, the delivery costs of the product at virtually nothing. And we're charging 40 points to give you an electronic promise to pay. Does that seem sensible to you? And I'm not for a second advising that MGAs should work for less money, but somehow you have to look at the whole chain, and somebody's got to stop charging so much for something.
If I can, just to comment on that, because it's something that John sort of talked about alignment of interests, right? And John talked about the fact that now they have better modeling and an ability to understand the expenses associated with MGAs. As an MGA, am I the only one who continues to deal with carriers who, as part of the remuneration agreement, say, oh, and by the way, there's 20% underwriting expenses? You go, 20%? Oh, how about 17.5? 7? Can we make it 16? And it seems to me that there isn't a sense of what the cost is. It's just, look, we're the carrier. We're going to build in a cost to you as our MGA, call it an underwriter's expense load, with no concept whatever of the cost of capital, or indeed the cost to them of managing that MGA relationship.
Is the cost you're referring to independent of what they're paying you?
Oh, yes. So in other words, if you're looking at an alignment of interest, which would include typically a profit share because you're both targeting an underwriting profit, they'll say, well, one of the things you need to deduct, of course, is XYZ capacity providers underwriting expenses of 20%, of 15%. Mm-hmm. And you say, sorry, where's the science in that?
Yeah. I think it's a really good point, James, and that's what I was alluding to. I think in an environment, being really clear about which activities are being transferred and being undertaken by the MGA versus which are residing in the insurance company is really important. And then if you can't differentiate between the cost base via an MGA versus a cost base of doing it yourself, then I think that's what creates the problem. So I think, certainly from our point of view, we spent a lot of time trying to understand, first of all, our own expenses, and secondly, how that plays out in an MGA structure, an MGA relationship. Otherwise, as you also allude to, the deals very often don't work. So we've got increased acquisition costs, or increased profit shares, or increases in different parts of the equation, but it's absolutely right that we offset that with a lower expense base in terms of the activities that we're transferring to the MGA. So it's an interest. I find it an interesting methodology and calculation, something we've definitely applied ourselves to make sure that we're very, very clear on the different models that exist with our MGA partners.
And certainly I would say that, and I can't speak for other carriers, but certainly I can speak for us as a group. I would like to feel that we were transparent about the capital that we allocate to a particular area, the cost of our hurdle rate return we want on that, the auditing costs, because that's really our costs, and there is something about reputational risk there, that we bear a risk that, if the MGA goes terribly wrong, we have got this whole run-off issue to deal with that. And in return, I think the MGA should be very clear about what its costs are and where its sort of adding value. I'd like to feel that in a long-term relationship that a great degree of the upside and potential downside can sit with the MGA without breaching any Insurance Companies Act or whatever, and that the relationship should therefore be one where the alignment of interest is not just a thin profit commission sitting on top of a fixed commission, but actually it's much deeper than that. So the argument I would put to you is that this should and will become a more competitive market, and if you're not getting the right degree of transparency from the carrier, go look for another carrier.
I'd echo that. Whoever's paying 20%, good luck with that. I think, James, it goes to your point about transparency, and I think collaboration, and we don't need the sort of cloak and dagger mystery that used to sort of surround an engagement with an MGA. I think now MGA owner-managers are far more professional. They're not trying to sort of game it every day of the week for more commission. So I think to Alistair's point as well, longer-term relationships normally are the best ones. And this sort of idea of an equilibrium between the parties is probably the only way you're going to make that work. So there has to be front-end transparency, but there also has to be a lot of disclosure.
And James, slightly provocatively, but the counter-argument to your statement is obviously if you want true alignment, you would calibrate your fixed income to cover your costs and keep the lights on, and your true profit in your business would be profit commission. And if it was on that basis, I'm sure you could get the 20% down quite considerably, because that would be viewed as much more aligned than a fixed income which delivers a 30-point profit or whatever.
I think one of the points I would try to make too is that I would argue that the MGA model is historically looked at being a very efficient one. And if the MGA says, for example, my underwriting costs, I'm going to cap those, I can run my business at sub 10%, and the carrier says, well, sorry, but ours are running at 14 or 18%, and we're going to charge you that for the privilege of our capacity, it rather works against the efficiency model that the MGA is trying to bring to that equation. So, Darren, I think your point is spot on, where we're sort of saying, well, look, why are we being charged more for what is effectively our more efficient trading model? We should be sharing more in what that drives in terms of ultimate profitability.
Anyone else have a question or comment?
On transparency, and profit. One of the big challenges for an MGA trying to realise a profit commission is the IBNR factor. So how could we be, or the carriers, be more transparent at the beginning of the contract rather than at the end of it on that subject?
I think
it's a little difficult until the losses happen, to be candid, but on the IBNR. But what they could do, which you see a number of carriers, for example, in the U.S., Progressive and a few of the other carriers publish their triangles, and they publish statistics that you as an MGA could look at and say, well, this is about what they have in IBNR, and so it's a fairly transparent exercise about what their IBNR is, so you could make a judgment at the beginning with that.
I think the other thing is that the more sophisticated the larger MGAs are investing in actuarial sort of resource, and certainly the ones that we engage with, we'll have an actuarial arm wrestle over the ULR pick at the beginning of the contract. Then you look at an annual exercise in either was that the right pick, too high, too low, and because of their the institute requirements, it's a proper discussion. No one's trying to sort of hide anything. So I think again it is transparency around those loss picks from the get-go on what is some considerable tail exposure now in some of these casualty books.
And underwriting agreements becoming more than just underwriting agreements, but underwriting and claims?
Underwriting and claims, and to some extent protection around clawback if you see bad years deteriorating. So the carrier isn't left holding the baby whilst the MGA remarkets, which certainly was an occurrence.
One might argue that should be both ways, though, to your point about the actuarial view being possibly too high. If it improves, then there should be some...
Yeah, for sure.
It should work both ways, but I think it's a really good question. And I think it is about, I know we keep using this word alignment, but alignment from day one, really. So through, I guess, an underwriting due diligence process, an actuarial marriage between both counterparties is really important, so that everybody is absolutely set on the expectations over the next 12, 24, 36 months, and then there's no surprises. So I would echo what the guys have said, but I think transparency and early agreement around that is really important.
And more appetite around claims delegation to an MGA, do you think?
More appetite around claims delegation. Again, I think that goes back to the product, the sophistication level of the product, which regulatory eye is over it. One of my biggest criticisms, frankly, is, and I think a big gap in the market, is for good TPAs, because we are far too quick to delegate to TPAs, and I think they're of very indifferent quality. I'd prefer to see more MGAs investing in direct claims handling. I'd prefer to see more carriers getting expertise rather than this notion that we can outsource that, and it's the dirty little secret of our industry, which the FCA have blown wide apart anyway.
I think it varies by the risk profile as well, and potentially by the line of business. So where we've got a heavy premium throughput with relatively low volatility, absolutely. We should. I think generally the market is looking at different TPAs and delegation of claims authority, and certainly from our point of view, we definitely considered it and have considered it in the past. So I think, but equally, you've got a very highly specialised line, potentially cat line or what have you. You might want to keep a hold of that claims handling in-house. But again, I think that needs to be agreed at the outset.
Just one more question while I have this. In terms of looking at an MGA that's got scale and diversification of product, both long tail, short tail, what's the view of the panel, particularly insurers, of supporting that MGA across all products? And if that is the view, how do you square that away with line of business underwriting in the insurance carrier?
I think if I just initially lead with that one. So I think, first of all, in principle, absolutely, because you get an immediate diversification benefit against the criteria that you said, multiple lines of business, potentially multiple geographies. But I kind of throw that back, because that then is about how much data can be provided, what's the quality of that data, what does it look like, can we get our arms and legs around it to make more of a horizontal type decision rather than a line of business decision. So I think that is a two-way street. I think that needs modelling. It's about sharing of data, but there is definitely an attractiveness around taking and looking at a horizontal play across multiple lines of business than maybe on a line of business specific only basis.
But you would argue that you would have specialists, they're the go-tos of their market. I think we'd probably say the same thing. So it's really a question of, is there a real USP around your offer that we're missing? But if you're just working in what I'd say is that generic wholesale space, there's probably increments of win or lose on either end. So that's it. If I was coming in unencumbered, an alternative carrier, certainly I wouldn't hesitate to back you rather than trying to pick off teams and build an infrastructure and all that sort of hassle. But when you've got an embedded team and your priority is to them, your shareholders, it's a very difficult equation.
I think the default position is yes, of course. If an MGA has got several lines of business, then that means the relationship is better. I don't think diversification for the carrier, we should be creating that in all sorts of different other ways other than through a single MGA. From your point of view, in terms of stability of the profit streams that you get from the underwriting, it obviously makes your position better. So I think the default position is yes, but then if you put yourself in the position of a carrier who is already supporting a niche somewhere else, and you decide to go into that same niche, that puts the carrier in a position where he's now got his paper going out with 2 MGAs writing the same niche. And therefore there has to be this ability to say, we'll support you generally, but it's not an absolute, it's a default position, now tell me more.
The skill is finding something different. If you say we've opened an office in Singapore or Dubai or Australia, that's not diversification, in my view.
I think one of the challenges to the MGA is that by putting all of your profit commission in one bucket above the entire portfolio, as opposed to product line separation, you're exposing yourself potentially to one particular class taking out the entire profit commission. So I think you've got to be pretty clear on your overall results and where you expect the profit commissions to sit.
There was another question at the back.
Thank you. I would have a question as regards alignment of interest, which we've already tackled. And we were talking about remuneration schemes. Another possibility could be risk sharing. For example, longer established MGAs put aside some of their historic profit and found a carrier and partly risk share. Is there a tendency from your point of view, from either MGA or carrier perspective? And then what do you think are the pros and cons of this risk sharing mechanisms to make the MGA model even more sound in the whole insurance value chain?
Sure, I can talk to that. So at Pioneer we have what we call a hybrid model, and in terms of the alignment, what that means is we have a share of our own corporate capital sitting alongside the carriers that back us at same terms, and we also have a mandated staff capital play into that sales structure which backs the underwriting as well. So what does that mean? Normally you've got alignment via the PCs, obviously, with the hurdle rate that James was talking about, which can vary. But having capital at risk, both personally and corporately, alongside the carriers and or alternative providers, is a significant sea change. And we certainly saw through our development, when we put that mechanism in place, there was significantly more interest in backing a lot of what we were doing across different classes of business. So I think it can't be applicable for everybody, because you've got to get to a level where you're generating enough funds, and really to do it, it's got to be at the minimus level, which is credible to the carriers and others. But it definitely does help if you've got that pure alignment. It's no longer just the loss of profit commission, it's the loss of actual capital if there's a bad underwriting result.
I think that speaks to confidence as well. So we're talking about partnerships, relationships, alignment, which I think was in the question. I think the ability to offer and to effectively to risk bear, to risk share, certainly speaks to confidence in the model, in the results, away from pure profit share and other metrics that are in place today. So I think, you know, we'd certainly welcome that.
It tends to keep the actuaries honest as well.
Yes, I mean, I would be comfortable, and we've done deals where the MGA has been but for the margin which gives us our hurdle rate return on the capital that we're having to allocate, all of the upside and all the downside. But the risk is, and this is where you need to craft the contractual relationship very carefully, if the MGA can no longer continue in business because it has now had a capital impact and it has no longer got the ability to go on operating, what happens to that business? Who owns it? How do you bail it out? So by taking more risk, there all has to be a thought about what happens if that risk actually occurs. And there are solutions to that. You know, there is no end to people's imagination as to how to craft that sort of scenario. But it must be done as part of the relationship and contractually. Otherwise, it's a recipe for tears.
In short, we're always happy to do business with people who like to eat their own cooking. And so the more innovative way you can come up with that suits your business, that's always, I think, a very positive thing when you're talking about creating an alignment of interests and making the carrier of whatever shape they are work alongside you and commit to you for a longer period of time. I suppose we've talked a lot about from the beginning, we talked about the, relative to the alignment of interest. Figure out what your points of strength are, and then make sure your capital provider brings something in addition to capital, for example, the assistance on the FCA matters and the rest, that you shouldn't ignore the alternative capital and some of the solutions it can provide for you if you have the right shape of an MGA. We took 45 minutes to get to Brexit, so you'll have to be aware of that in the future. I think that's more than should be said about it. Expenses we talked about, and it's not so much about who gets which piece of which pie as I think the whole industry has an expensive pie. Mm-hmm. And so as pressures come on people to carriers to try and figure out how to do things more efficiently, indirectly or directly, you'll get some of those pressures on the MGA model. And key to that is if you're providing a service, you have your costs and that. Find a carrier that is going to be responsive in not doubling up the costs so that they're a better partner for you and they fit better, I think is one of the things that got said. I think there's the issues for both parties on reputation of service in terms of how you work with the claims things and how things go. Very few of us draft an agreement that's in full consideration of how we'll all behave when things go wrong. Most everybody's overjoyed at doing business together, and you don't really anticipate that. But as a person who cleaned up 603 binding authorities over a period of 12 years, with any number of human resources devoted to that. And also I've worked at Berkshire where National Indemnity sells through MGAs, and the average tenure of their MGA is, I think, somewhere between 17 and 19 years. And it's a wonderful distribution system, and it's incredible relationships, and it's fabulous. So I've seen it work at its best, and I've seen it work at its absolutely, positively worst. In fact, the poor underwriter, even when he did the right thing, he had bad luck. So it can be the best of times, the worst of times. But if you spend a little bit of time nowadays just thinking about how things can move, because it's a soft part of the cycle. There's a lot of changes on almost every front. Big data, other kinds of analytics, even the technology you can bring to the party today to do what you do is enormously different than what was available 5 years ago. And a lot of the MGAs I talk to, part of their value proposition is they can access that in a way that a lot of other people. There's still only 1% of the people who work making their money from the internet, if you think about it. And that's not going to stay there. So if you all can hitch your wagon to that star, I think you'll go pretty far. But you need to know what you're doing. And so I think carriers are evolving. There are ridiculous amounts of regulatory pressures on everybody, and they'll only get more involved as we go through the next 2 years. But it'll affect our distribution channel, where we count on the MGA to bring us opportunities that it's far more sensible for the MGA to be the distribution channel than the carrier having other methods. So I think everybody here is giving you a few insights into what they might be, and I appreciate your time and your questions. Any last questions before we close out?
Do you see yourselves, in terms of your future assessment of MGAs, imposing potential minimum requirements for things like FRS 5, depending on the tail of the business, i.e. short tail, long tail, etc.? Because, I mean, the answer to the earlier question was, to some extent, we should be just balancing the books on our fixed commission, and the icing on the cake is the PC, which puts us in alignment with you. But of course, if on long tail you're sort of going to say, well, actually, what we want is to see a bigger FRS 5 element being retained, then it adjusts that calculation, shall we say, in that sense of it. Because if the concern is the MGA is going to fold and leave you potentially with a pile of business to run off and claims to deal with, is it going to come back from you as carriers in terms of, well, when we're assessing the MGAs and looking at it, this is what we want to see?
Who wants to start with that? Well, you
you're far away.
I think inevitably there is an element going to be of that, of the long tail business. And it's a complicated formula, because it's not just the underwriting costs. It's also the actual loss adjusting expenses, which on a long tail account get picked up. I go back to this thing about embedded in the whole profit commission or profit sharing relationship with an MGA writing long tail business is the exit strategy for both parties when things go wrong. And I think that's a really important embedded part of the discussion. It may be that when it all goes wrong, effectively the renewal book gets owned by the carrier, and so they effectively own that bit of your business, but they go on holding the baby. That might be one of a range of solutions. So I think that you can't be prescriptive about it. Inevitably, yes is the answer, but how it pans out for particular lines of business is got to be something that sits between you and the carrier.
And it's got to be agreed with the carrier as well. So I go back to the conversation we had earlier around agreement at the outset. I think it's really, it's another example of something that miscommunication or a poorly drafted contract can lead to all sorts of issues further down the line. So we certainly trying to get that transparent agreement up front is critical.
No, I agree.
It doesn't feel like it doesn't feel like an imposition. Then it's a mutual agreement, and everybody's clear on it rather than being imposed.
Again, if you look at some of the experience in the States, there's some big program managers who are getting bought out as a carrier. If you're on the receiving end, that's a big gaping hole in your budget. So carriers are finding more and clever ways to get more hooks into that arrangement where there is a cultural alignment, a long-term perspective, call it what you will, but we're using options, we're using sort of debt financing, all kinds of renewal rights arrangements to give us a step-in right if some event happens, be it hopefully not an insolvency, but maybe it's a sale. Partners want to crystallise their equity and retire. That's quite a common theme around MGAs. So I think what our response has to be is a more creative solution to enable that, because we do have the capital. We don't want to become the quasi bank, but for both parties, it's often more favourable than having some VC money put in. And if your carrier is looking to have that arrangement, or you want to have that conversation, it's definitely worthwhile, because it's starting to happen here. I was here a year ago. The deal we did with Axiom was very much about that. As a retiring partner, they wanted to crystallise equity. They didn't have any working cap, so we took a share, and we made that happen.
Any other questions before we part? So if I could ask you to thank the panelists for sharing their thoughts in the usual way.